We are presenting Enron, the smartest guys in the room. I am Tequila, Lyons.
And I'm Johanan, Mushota.
A little bit of background on the movie is that Enron was an oil trading company. It was the 7th largest corporation in the United States. Over 16 years, it went from a $10 billion company to a $65 billion company in revenue. It took only about 10 days for the company to go completely bankrupt. Enron was a poster child for the new economy in early 2000s.
Key important people at Enron. The founder was Kenneth Lay, and after he founded the company and after a while, he hired a person who was Lupai. Lupai worked as the CEO for him, and after some time Lupai left the company. Then Kenneth Lay had no choice. He started looking for somebody else, and he came across a person by the name of Jeffrey Skilling, who stepped in as a new CEO. And later on, when Jeffrey Skilling left us, we are going to explaining into the following PowerPoints, Kenneth Lay had to step in back as the CEO himself. Other important people in the company, we had the Chief Financial Officer, and his name was Andrew Fasto. And the Chief Operating Accountant was Richard Corsi, and Chief Risk Officer was Richard Bai. And we have also some important people, although we didn't speak about them in the PowerPoint, but they really played a big role. People such as Amanda Martin, who was one of the first executives hired by Jeff Skilling. We have also Sharon Wilkins. She was Enron Vice President, and she worked with Andy Fasto, who was the Chief Financial Officer of one of the Chief Financial Officer of Enron, as we explained. Okay.
3 ethical issues that we found within the movie was cooking the books, embezzlement or misappropriation, appropriate use of company assets, market and personal manipulation, and auditor fraud. The auditor fraud was committed by a company called Arthur Andersen.
Now we're going to speak about the first ethical issue, which was cooking the books. Cooking the books, it's a common term used in accounting, and it simply means at the end of a financial period, you have to submit the book. Those books are the financial reports. Now, cooking the books means instead of presenting those books just as they are, you cook them or you falsify them. So this is what Enron was doing at the end of any reporting periods. What they are going to do, they will take their financial report, which means their balance sheet, their income statement, and so on. They will falsify them and put everything that they wanted on those reports, just so that the company looks good. So that was misrepresenting statements about profits and showing that profits have doubled while profit didn't double at all. Then they came up to something that they called mark to market. It was also something which is not recommended in accounting. Actually, it is illegal, so to speak, in accounting. So that is when you expect future revenue, future money, you recognize it into the current financial period. Because in accounting, you have to recognize revenue only when you earn it. But then they used to show revenue that they expect to earn in 10 years' time. They put it on their current reports. And obviously, they also paid billions in bonuses on profits that didn't exist. And their financial documents never showed any fraud. They started overvaluing their stock because they had to work with the Wall Street. There are some representatives there selling their stocks. And whenever they did everything they could to make sure that their stock was highly valued while it wasn't. And they stashed debt in Fast and Company, preventing investors seeing it. So I'm trying to kill a bit time to go a bit slow to make sure I don't cover 45 minutes.
Embezzlement of company assets is the next theory that we came up with within the movie. A gentleman called Louis Bogart took $3 million of company money and put it into his personal account without having any receipts or documentation that could show where the money had went. When he was audited, he presented false bank statements. The company also used money for personal pleasures, such as a part in the movie they are shown going on different motorcycle rides as enjoyment, not something that was for company use. Another thing is that they went on expensive dining trips. However, they weren't taking like clients or potential clients or investors out for like sales of stock and things like that. They were going out for personal pleasure, like with family or by themselves or something like that. They also use the investors' money to sponsor the Bush campaign. That's something that's not really good to do. It's more frowned upon when you support a political campaign as a financial company.
And another ethical issue they had was market and personal manipulation. There was this thing which was called pump and dump. So that was what they used to do, is because most of their people used to get paid into stock option. A stock option is a system whereby a company, instead of paying you cash or as a salary or as a bonus, they give you some stocks of the company, and you can sell them at any time that you want and get cash in. Now the advantage is, let's say if one stock equals $1, they pay you today 10 stocks, so you have $10. But if the company is doing well, after you are patient, you don't cash those stocks in, and the value of one stock become, let's say after 12 months, $2, you have 10 stocks, it simply means now you can cash them in and have $20. So you've just doubled your pay. So it is a system that most companies use, but now they took advantage of it in a bad way, in a sense that they used to pump and dump, meaning they will give false reports on the Wall Street and so on, so that the value of their stock goes up. They know very well that no, it's not for real, it's not true. And when their value of stock goes up, they sell it, they get rid of it, dump it, and they get their money, and they know that maybe the following day the stock will go down again, but they've cashed it, they got their money. So that's what they used to do. And they also took over an energy company in California, which is the name of PGE, and they created what you call ricochet. And that was simply, we know that price is always a factor of supply and demand. If there is more demand but shortage in supply, then price goes up. So that they created a deliberate shortage of electricity. We know that electricity companies are government regulated because the government doesn't want those kind of things. That's why they give them monopoly. Like you see that Duke Energy is the only company which is allowed to supply energy, but in return they have to obey to certain rules from the government. But then they took advantage of the monopoly. They started cutting on purpose power to people, and then or to some companies, claiming that there was shortage and so on. And companies were willing to pay any price so that at least they can have a piece of energy so that they can work. And they took advantage of that, and they started making a lot of money. And obviously, there were some of the people who pushed a lot for the liberalization of companies. They didn't want any company involvement into business. And the government gave up, accepted. But when the government came up with those measures saying that, okay, the government shouldn't now get too much involved into companies, the government had some loopholes. So they took advantage of those loopholes, and they used the energy company the way they wanted, and they make a lot of money. Another thing is they make fake derivative options. So they transformed the oil company into some sort of derivatives, and the derivatives is just a way of betting. So you are trading something that doesn't exist. It is a movement that has become very popular into the financial world, but it is meant for intangible assets, not for tangible assets. And then it was an oil company, so there was no reason really to go that route. And they also invested into a power plant in India, which was not really profitable, and that was just a waste of companies' money because everything went into the ground.
Another ethical issue that we came up with from the movie is auditor fraud. Like I mentioned earlier, the company that they used for auditing purposes was called Arthur Andersen. They basically closed their eyes on the mark-to-market thing they came up with that he talked about earlier. They also approved false financial statements. They knew that the financial statements the Enron was producing was not correct. However, they didn't do anything to prevent them from publishing those documents. They went ahead and continued to do so. They were also paid from Enron $1 million a week as a type of bribe to basically kind of go ahead and say that the documents and things like that were accurate and correct, and kind of just turn their heads away and keep making that money for them. In the movie, they were shown that they helped shred all basically documentation to avoid getting caught as part of being part of the embezzlement scheme that Enron had going on. They were also the biggest auditor company in the United States at this time. However, once Enron did collapse, the government did shut this company down, so they were no longer able to help run other companies into the ground or help investors lose their money in a company that they know was not a good, profitable investment.
Now, we came up with some ethical theories that we can link to those those frauds that we've just spoken about. Now, the first ethical theory is related to what we learned in class as part of this semester, which we call the stakeholders impact analysis. And the stakeholder impact analysis takes into account the consequentialism, the ontology theory. And we had also another ethical theory which we call virtue ethics. Now, speaking of stakeholders analysis, impact analysis, consequentialism analyzes a decision in terms of harm and benefit to multiple stakeholders, and to arrive at a decision that produces the greatest good for the greatest number. So, meaning, if you're a consequentialist, before you take any decision, you have always to weigh the positives and negatives consequences of that decision. And if you notice that no, there are more bad consequences than good consequences, then that decision shouldn't be made at all. But only when you realize that no, overall, the average consequence of that decision is going to be good, then you can take that decision. and it will be considered ethical, otherwise it is unethical. Now, another theory which we call deontologies, they don't really look a lot at the consequences, but it looks at duties, right, and justice consideration. So it teaches you to use moral standard, principles, and rule as a guide of making the best ethical decision. For deontologists, they always say, okay, if you want to make a decision, you must always think if that decision can become a rule, if it can become something standard that everybody can use and it won't hurt anyone, everybody will be happy with it. If you find that no, you're making a decision but another person wouldn't make that decision or it will hurt somebody, then it shouldn't be done because it is unethical. Another theory also is what we call virtue ethics. This theory focuses on the character or integrity of the person who is involved. So it goes really to the traits or characters such as being patient, that is a character. Being polite, that is a character. So it also shows that a character can play a role, a big role into doing something which is ethical or not.
How we were able to tie the theory of consequentialities into the ethical issues within the movie is by when they were cooking the books, basically. They were falsifying the documents, which was not thinking about the investors' money. They basically didn't care that they were taking the investors' money and using it for their own personal use or helping run the company into the ground eventually. And the investors would be left without any of their stocks or any of that money to be able to get back. They also were hiding debt in other companies, such as the LJM, which was not looking out for potential investors. Basically, by hiding their debt, they were looking as a good, profitable company to invest with. However, they weren't making the best decision for everybody with that. They were only worried about their current stock price to make sure that it was going to continue to rise. By doing this, again, they weren't making a decision that was going to be beneficial for everybody in the long run. They were kind of worried about the short term money. The Arthur Andersen also ties into this theory by knowing that it was wrong to shred all the documentation. However, they continued to do so anyway without realizing who it could potentially affect, such as it could have, the investors could have possibly got some money back, or they could have, in a lawsuit eventually down the road, they could have got money back that way if them documentations weren't shred from them investing within a company that was already ran into the ground. They also okayed cooked documents, knowing that it would have a huge impact on investors as well. So by them allowing these documents to be published, they were basically not worried about making the decision to create a good document for people.
Now, speaking of deontology, one key aspect, as Taylor spoke about, was embezzlement. They used to take companies' assets, companies' money, go on fancy excursions, for dinners, and spend them on their own things. But now, deontology theory kick in the way that if you're a moral person, you know very well that you shouldn't use companies' money for personal pleasure and expensive luxuries and so on. From a deontologist perspective, that is really unethical. And because they couldn't will that employees or somebody else could take company's money and use it on personal pleasure, because that is what the ontologists say. Before you do anything, you must always will that somebody else will do it and you'll be okay with it. If you know that you cannot will that somebody else does it, then it is unethical. But in this case, they knew that no, what they did, it was only good if themselves did it, but if somebody else could do it, they couldn't accept it. So basically it was unethical. And some action of some people were not based on duty, right, and justice, as we've explained. And for instance, we have the case of Lupai. He left the company when he knew that no, the company was not doing well, and he took with him a lot of money, leaving a company in big damages. So these are kind of some attitude or behaviors that were common at Enron, and from a deontologist perspective were really unethical.
The third one that we used was virtue ethics. This ties into the personal and market manipulation part. They was willing to not only lie to themselves, but they were able to lie to the investors as well without having any issue with that. It really kind of shows what their character was all about. They wanted to make a personal gain for themselves, which as lowering your integrity, basically. Jeffrey Skilling also mentioned that the money was the only thing that motivated people in the movie. He came up with a policy to basically demote people that did not increase the stock market. At one point in the movie, they mentioned a statistic that they were getting rid of 15% of employees every year that did not reach the target stock price. So they had certain amounts of stock that they had to sell each year. And if they were not able to make or reach that goal, they were basically fired because they were not being profitable to the company by helping get in more and more money that they could eventually use for their personal use or things like that. Jeffrey Skilling had a bad character of himself, however, he did not see it that way. He was kind of arrogant that he knew what he was doing was wrong, but he was definitely okay with it.
All right, then after ethical issues and ethical theories, we did also some outside research and see what happened afterwards. Now, the first one concerned former employees, because the collapse of Enron, as we know, it had a lot of employees. We mentioned about 7,000 employees.
Mm-hmm.
And all those people had to lose their job when the company collapsed. Obviously, some killed themselves and so on, but at least others managed to find some job, more especially like people were, we can say, almost innocent and common employees. They moved on and started working. But others also didn't work out really very well because they are close to their retirement. And as we mentioned before, those people were paid not in cash. Every month they used to get a paycheck, and on the paycheck there were stocks. So the company gave you stocks, not cash. And they were happy. They used to say keep a bunch of stocks. They know that, okay, when the value goes up, they can cash them in and make a lot of money. Now we have a case of a person. His name was George Maddox. He has his retirement also paid in stock. What a mistake. You can maybe get your salary in stock, but you don't want to get paid for your retirement into stock. So that was happening also. That's what happened. And because of that, he lost all his money. He was forced to make ends meet in his golden years by mowing pasture and living in a rundown farmhouses. And he worked for the company for 30 years, and he just retired before the company went into that downward spiral. And the amount of stocks that he had just before his retirement, which were invested into his retirement plan, was 14,000 shares of company. And now at that time everything was good, because that 14,000 shares, if he could cash them in, he was supposed to get 1.3 million. And of course, why should he rush? Because by waiting, we know that good companies, usually stock keeps on going up. So let's say if he waited again, maybe a year or two, his hope was that, okay, if he can cash them in, instead of 1.3 million, he can even get 2.6 million, and so on. So he never saw the collapse, but unfortunately, when the collapse came, he lost all of that money. So that was one of the sad consequences, among others, that happened to people at Enron. And
with the employees, this was they lost about roughly $2 billion in pension plans. I know to a lot of older people, pension plans was something that they really valued and put a lot of money into, because you see not many companies these days offer pension plans to their employees. So this is something that they really thought good of, the company put their money into, but they eventually lost roughly almost $2 billion due to the collapse of Enron. Deontology plays into an effect because many people believe that the vast majority of employees took part in the greed and dishonesty that eventually corrupted Enron. I thought that was an interesting statement that was made for the article that we found. So employees did not agree with this, but they would take a lot of effort to regain their credibility. Basically, they knew that the company was going down and they were okay with it. They continued to help embezzle money and things like that, which eventually led to the downfall. Consequentialities plays into an effect because by other employees participating in the dishonest behavior, knowing the potential effects that it could have on previous employees that have already retired, potential investors, things like that. However, they chose not to say anything. So by not saying anything, they weren't thinking about the greatest good for the greatest number of people. They were more focused on being dishonest with themselves and continuing to work day by day to help run the company into the ground, thinking that they could potentially gain something from that, when in reality they weren't going to gain anything.
Then we also looked at another research outside sources, and this is what they call the Dodd-Frank Wall Street Reform and Consumer Protection Act. It is something that happened recently. Maybe a bit of background before this act came into effect in July 21st, 2011. What happened is, as we learned in class, after the Enron scandal, SOX, which is Sarban, so the Security and Exchange Commission came up with what they call SOX, and SOX is Sarbanes-Oxley Act. And it has so many things that they came up with to try to prevent this kind of things from happening again in the future. And one of those provision is what they call Section 806. And Section 806 just provide protection for whistleblowers. Because what happened at Enron, so many people knew that, as Taylor explained, employees were involved. Somebody, almost everybody knew that no, what is happening is not right, but they kept quiet. They didn't blow the whistle. And if that could have happened, then maybe somebody was supposed to step in, or the government was supposed to step in and stop that bad consequences the way it happened. So this Act 806 was actually meant to make sure that, okay, in the future, at least they can encourage people to come forward and blow the whistle. And even Arthur Anderson, who was the auditor, they could have also at least blow the whistle if that Section 806 Act was in place. Obviously, they were the auditors. It was their duty to make sure that at least they report what is happening. But within Arthur Anderson, there were also people who knew that no, our auditing company is not doing its job. Those people also could have gone up and to the Security and Exchange Commission and say, look what is happening, but nothing happened. But after its implementation in 2002, the Security and Exchange Commission hoped that, well, now people are going to come forward, they will start to report any bad things, but it looks like no. People were afraid of doing so because you know what is going to happen if you notice that your company is doing something wrong, you go to the government, you report that. Eventually, the companies may find out that you are the one who did so. They can pay fine and so on, but you may be fired, you may lose your job. So that Section 806, it worked, but it didn't work really very well. It needed some help.
In July 1st of 2011, the Dodd-Frank Reformation Act was put into place. Basically, with this new law in place, whistleblowers had protection against any retaliation that could potentially happen. So, like, if they knew that a company such as Enron was embezzling money and things like that, they could turn them in, and anything that the company wanted to do, such as fire them or something like that, they were protected against that, where that couldn't happen. Also, a benefit for them to turn in a company that was doing something wrong was that they were getting commission fees ranging between 10 and 30% of any of the amount that was collected or charged to the corporation in the violation of financial regulations. So that was a kind of extra incentive to get people to turn in companies or auditors that were doing things wrong, to help gain some benefits to that, rather than thinking of the negative effects that could happen. An example of that would be with the Ernst & Young was another audit company that tried to follow the Arthur Andersen behaviors. However, once this Dodd-Frank Act was put into place, a whistleblower was actually able to turn them in without having any retaliation against them, which was a good thing. They helped stop another audit company helping potentially run another company into the ground, such as Enron. So the reward for this whistleblower was that on April 16th of 2015, which was just recently, the company was ordered to pay $10 million to settle the case. So based on the commission, they would get $3 million in commission just by turning that company in and stopping any potential losses that could have occurred. So that was a big kind of payoff for that person to do the right thing and put their virtual ethics into play at that point.
Then Another outside research, we looked at Enron stock chart from the investigation perspective. So we wanted to see how the stock price was throughout the years. I don't know if it is clear enough. Yeah, so this is the chart which shows what happened throughout the years. Now we will go into some key things that happened.
As you saw on the chart, there was different letters. So letter A was between 1996 and 2001. It was the Fortune magazine named Enron the America's most initiative company for 6 consecutive years. So that's kind of something that's pretty important and recognizable for a company that was essentially embezzling money, running it into the ground, and not many people knew or saw it coming. The second one was B, which was between 1999 to the mid-2001. A group of 29 Enron executives and directors received about $1.1 billion by selling 17.3 million shares from the 1999 to the mid-2001s. This is according to court filings based on public records that obviously was not shredded in the destroyation process, saw in the movie to help get rid of any documentations that could potentially be used against them. Point C was dated for April 17th, 2001. This is when Enron announces $536 million in profits just for the first quarter, which kind of seems like a lot. As points that we pointed out previously, they were obviously making up different profits than what they were truly gaining. So that number could be accurate or it could be falsely represented.
Another thing is in August 14th of 2001, when Jeffrey Skilling resigned suddenly from his position as a CEO. Obviously, in court, in the movie, it says it was for personal reasons. That's what he said. He knew what was coming, but he said absolutely no accounting issue, no trading issue, no reserve issue, no previously unknown problem issues are beyond the departure. So he said no, he just left and he didn't see anything coming. And as you can see, he was a very clever person because he decided to leave a little bit earlier. So he knew that, okay, the way things are, they still look good, but in 12 months, they won't be looked at all. So this is time for me to leave the company. So that's what he did. And another thing also which transpired in August 20th of 2001, Kenneth Lay, the CEO who took over, of course, after Jeffrey Skilling, he sold 93,000 shares and he earned $2 million. And he also urged the employees that they should buy company shares, but he knew exactly what was going on. And when things were not going on, he sent emails to employees telling them that no, everything was going on, everything was going just as good as they should, and they shouldn't be worried about anything. He was going to step in and they shouldn't worry at all. And on his email, he said, one of my highest priority is to restore investor confidence in Enron. This should result in a significant higher stock price. So again, although things were going bad, he still, until last minute, he was misleading himself only thinking about this stock price, raising stock price, pushing everybody to buy that stock. Any ethical issue, how could he make that money? How could he raise the value of the stock? He didn't worry at all about that. And another thing that we discovered from outside sources is that on September 26th of 2001, he was chatting online with his employees, and Kenneth Lay said that Enron stock is a good buy and that the company's accounting methods are legal and totally appropriate. So as we spoke about the mark-to-market thing, we know very well that no, that thing was just a made-up thing, and we know that accounting is a profession that there are so many rules. It's just kind of law, or so you cannot just do whatever you want. You cannot just come up with whatever you think is good. But he came up with the mark-to-market thing, and although it created a lot of damages, he didn't worry about it. He kept on saying that it was a good thing or a good policy for the company. And he also said that he and other senior executives are very confident about Enron's prospects, that they have bought stock within the previous 2 months. So pushing people to buy junk stocks, and for him, no, it was a good thing. There was nothing wrong about that. And he kept on predicting, coming up with good predictions, fooling people around, saying that no, the third quarter results were still going to look really very good. There was nothing to worry about.
The next one was on October 16, 2001, which would have been in the third quarter for Enron. They reported a loss of $618 million, which if you think back in April, they just reported they had so much gain in profits, a little over $5 million for the first quarter, and then a couple months later, they ended up losing $618 million. That should have been a red flag to people, like, oh, this company is doing something wrong or something like that, because losing that much money in that quick of time, I think would be very scary for not only the company, but the investors and things like that as well. On October 22nd, 2001, the SEC opens an inquiry into Enron's accounting. So at this point, it did push a red flag out there to people. Now they're being looked into and investigated, how they could go from being such a profitable company to losing that much money within a couple months. On December 2nd, 2001 is when Enron eventually filed for bankruptcy protection. That's when they knew, now they're being investigated, looked into, we're in trouble, we need to do something, let's go file for some protection against our bankruptcy.
So we have some final recommendations, and it's a lesson to be learned from what happened at Enron. We know that it shaped the world, it shaped the history of not US, America only, but of the entire world, because of that, we have now new laws which came into effect that people have to live by. And as a final recommendation, we know that what we can say is falsifying documents or cooking the book is a very bad thing. It leads to downward spiral, and when you look at what is happening today, situations have improved, but still, every year we see that some companies still get fines and fines, a lot of heavy fines for trying to cook the book. It looks like some people cannot just understand, maybe it is greedy again, people love money, cannot get enough of money, but some companies, some people, CEO, executives keep on continue doing that. So, which is a very bad thing. So if you happen one day to be a CEO or into high position, the best thing is to make sure that if your CFO, chief financial officer, or anyone in the company tries to cook the book, you should really stop that, because you know that If you don't stop it, you don't blow the whistle, CEOs can be fired, but you also can pay heavy set consequences like those people who lost their pensions and so on. And when you work for an auditing company, because some auditing companies are there to make sure that bad things such as cooking the book doesn't happen, but unfortunately experience has shown that, just like Taylor said, after the Arthur Anderson thing came up, Ernst & Young, which is a big audit company, came up again, wanted to do something like that, but this time there was a whistleblower which came up and did a good thing. So that is a good thing to do if you work for a company. You notice that something is not right, don't be scared, you have to blow the whistle. Another thing is, at Enron, there are so many committees. They have the executive committees, there are the finance committee, there are any type of committee you can call, you can speak about. But they didn't have a risk assessment committee. Because if at least they had some risk assessment committee, somebody was supposed to come and say, hey, guys, it looks like things don't look good. They could have taken some measures beforehand, but nothing like that existed. So a company should have a risk assessment committee, and as we learn in the book, somebody like a chief risk officer or chief ethics officer. Those are something that is important for company. And where people have power in the company, you're in charge of making decisions, always think of theories such as consequentialism, which is always try to look into action. Is this going to result into the benefit of the most of a lot of number of people? If you know that any action won't benefit people, don't do it. And another theory to always keep in mind that we've learned throughout this semester was deontologism. So when you want to make a critical decision, always think, can I will that other people also make this decision and it will work well for everybody? If yes, then it is an ethical decision. Otherwise, it is
not. Some interesting things that we saw in the movie, but was also touched on in the book in chapter 9 on page 659, was the sentencing that the kind of main important people that played a role in the bankruptcy of Enron received. For example, Kinley, which obviously was the founder and the CEO, he pled not guilty, but he was eventually obviously found guilty for conspiracy, fraud, and false statements. However, he did die before his sentencing, so he did not have to serve any of his time. Another one was the Jeffrey Skilling, which was another CEO. He was also charged with conspiracy, fraud, false statements, insider trading, and securities fraud. He pled not guilty, but he was eventually found guilty. He received 24 years and a 4-month sentence, while having to pay $45 million. The CFO, which was Andrew Fastow, he was charged with securities fraud as well. He took a plea deal, so he was admitted he was guilty. So he received a 10-year sentence. However, it was later reduced to only 6 years. He had to forfeit $23.8 million. And then the CAO, which was Richard Cowsey, he was also charged with securities fraud. He took the plea deal as well. So he only received a 7-year sentence and forfeited $1.25 million. Okay, so this wraps up our presentation. We came up with 2 discussion questions. The first one being, from hearing about the bankruptcy of Enron and how it caused such finagle financial statements, what are possible ideas to help protect companies from repeating the same spiral downfall in the future that you could come up with if you were someone in charge, such as the CEO or CFO or something like that. The second one that we came up with was that if you were part of the Arthur Andersen audit team, would you have been able to so quickly just turn your head and kind of overlook the things that were happening leading up to the downfall of Enron, such as basically it's all happening right in front of your eyes just because they're paying you $1 million a week, which is, I mean, that's kind of awesome. Most people would take it, but would you personally take that kind of reward just to turn your head and help run a company into the ground while taking money from innocent people that have no idea truly what's going on the back end of things? Kind of why or why not? I think different people would and different people would not for different reasons. So I think that's going to be something interesting to see where people, their thoughts are.